Trading consistency does not arise from predicting the next market move, but from patiently waiting for the market to prove its intentions. The vast majority of traders fail not because they lack technical knowledge, but because they lack the discipline to wait for structural confirmation. Richard Wyckoff, one of history's most influential market analysts, observed this critical flaw in the retail mindset nearly a century ago. His entire methodology, designed to help the individual trader adopt the mindset of the professional composite operator, was built around eliminating this inconsistency. The framework he created provides a logical, step-by-step approach to identifying the actions of the smart money. The failure rate in trading remains stubbornly high, with statistics consistently showing that upwards of 90% of retail participants ultimately lose money. This staggering figure is often attributed to poor risk management or emotional decisions, but Wyckoff identified a more fundamental structural failure. He understood that inconsistency is the direct result of entering the market prematurely, long before the major forces have completed their preparation. Wyckoff's work offered a powerful antidote to this chaos by providing a clear lens through which to view market cycles. This perspective allows the disciplined trader to move beyond mere speculation and align themselves with the powerful, calculated campaigns of the professional composite operator. Wyckoff's promise to his students was not guaranteed wealth, but a reliable framework for consistency built upon understanding market structure. He taught that price movement is not random noise, but a calculated result of supply and demand engineered by large institutional players. By learning to read the preparatory phases of the market, traders could stop chasing immediate fluctuations and start anticipating major trends. This approach transforms trading from a high-stakes gamble into a meticulous process of structural confirmation. The key to unlocking this consistent approach resides in a single paramount rule that Wyckoff strictly enforced. The single most important rule Wyckoff enforced for trading consistency was this: never trade without a fully developed cause. This rule is the bedrock of his entire methodology, mandating patience and structural confirmation above all else. A trade entry is only justified when the preparatory work, the cause, is complete and confirms the institutional intention to move price significantly. Failing to adhere to this rule means entering the market based on hope or impulse, which is the definition of inconsistency. The cause must be visible, measurable, and confirmed by volume and price action before any capital is committed. Before we delve deeper into how this rule separates the consistently profitable traders from the 90% who fail, please take a quick moment to subscribe to the channel. Hitting that subscribe button and leaving a quick comment, even just a single word, provides crucial feedback. This simple action significantly helps the algorithm recommend this video to more people who are seeking consistency in their trading. Furthermore, I urge you to return to this channel, and specifically this lesson, during those challenging times when trading becomes difficult and your confidence starts to waver. Wyckoff defined the cause as the preparatory phase that occurs within a trading range, specifically the time dedicated to accumulation or distribution. This phase is characterized by the composite operator meticulously absorbing shares from weak hands or unloading shares onto enthusiastic buyers. The trading range itself is not the trade. It is the laboratory where the subsequent market move is being prepared. The duration and magnitude of this preparatory phase determine the potential energy stored for the ensuing price movement. The fundamental principle governing the Wyckoff methodology is the law of cause and effect. This law states explicitly that the magnitude of the ensuing price move, which is the effect, is directly proportional to the size and duration of the cause. If the accumulation phase is long and wide, indicating significant institutional buying preparation, the resulting uptrend will likely be substantial. Conversely, a short, shallow distribution phase suggests a lesser potential downside move. Therefore, assessing the size of the cause is the first step in calculating the potential reward, which is a key component of structural discipline. Consistency in trading requires the individual to abandon the reactive mindset of the crowd and adopt the calculating perspective of the professional composite operator. The composite operator views the market not as a random walk, but as a calculated long-term campaign designed to execute a strategic objective. Professionals are not rushing to enter. They are patiently waiting for the optimal moment to strike after their supply or demand objectives have been met within the trading range. They understand that premature action only risks exposing their intentions and wasting capital in volatile, directionless price action. The primary reason most retail traders fail to achieve consistency is that they trade based on immediate price action, which is merely the effect, without confirming the underlying structural preparation, the cause. They see a sudden spike in volume or a sharp move off the lows and feel compelled to chase the momentum. This impulsive behavior completely bypasses the rigorous analysis required to confirm that the professional campaign is complete and ready to launch the sustained trend. Trading the effect without confirming the cause is akin to jumping into a rocket that hasn't finished fueling. Wyckoff rigorously taught that the professional waits for the setup to complete, understanding that the greatest rewards come only after the market has fully prepared its move. This waiting period often spans weeks or months, during which the retail trader grows impatient and seeks action elsewhere. The professional discipline is rooted in the recognition that the trading range is a necessary evil, a period of structural preparation that must be allowed to run its full course. Only when the cause is fully developed, confirmed by multiple tests, does the professional commit significant capital. The failure to wait for a fully developed cause is the critical error that separates the profitable few from the struggling majority. This impatience manifests most visibly in the primary failure of attempting to trade within the middle of the accumulation or distribution structure. Traders often see the initial volatility after a selling climax or an automatic rally and believe the trend has already begun. They attempt to scalp minor moves within Phase B, which is specifically designed by the composite operator to confuse, shake out, and exhaust premature entries. Entering a trade during the middle phases of the cause guarantees exposure to whipsaws, false breakouts, and frustrating volatility. The composite operator is actively working to build their position during Phase B, meaning the price will often reverse abruptly, testing the conviction of early entrants. Retail traders lacking the structural map interpret these internal swings as new trends, leading them to enter, stop out, and re-enter repeatedly, exhausting their capital and their psychological resilience. Wyckoff warned that the middle of the range is a graveyard for the impatient trader. A significant aspect of the 90% failure rate stems from traders focusing on market noise while ignoring the essential structure. Noise consists of minor daily fluctuations, minor news events, and short-term volatility that distracts the trader from the larger preparatory picture. Structural analysis, by contrast, focuses on the larger phases of the trading range, the crucial high-volume events like the selling climax and the subsequent tests of supply. Reading the structural map means understanding the composite operator's campaign, which is far more important than reacting to the hourly tape reading noise. The structural map is confirmed by meticulous analysis of volume accompanying price action and, crucially, by the point and figure count. The point and figure methodology allows the trader to quantify the cause, providing a measurable objective for the potential effect. If a trader enters based solely on a dramatic candlestick pattern without confirming the structural phase or the quantified potential, they are trading blindly. The consistency Wyckoff sought demands that the trader prioritize the structural evidence over the emotional pull of immediate price movement. The 90% fail because they enter before the market provides definitive evidence that the composite operator has completed their campaign and is ready to move price out of the trading range. The completion of the cause requires specific, high-conviction signals that confirm the absorption or distribution process is finalized. These crucial tests are the market's final shakeouts designed to ensure that the path of least resistance is clear for the ensuing trend. Entering before these tests means placing a bet on an unfinished process. The crucial tests missed by impatient traders include waiting for the successful execution of the spring or the definitive sign of strength in an accumulation structure. Similarly, in distribution, traders often miss the upthrust after distribution or the clear sign of weakness. These events, occurring in phase C and D, are the market's final confirmations that the cause is fully developed and the effect is imminent. Wyckoff's rule demands that the trader wait for these undeniable signals of commitment before risking capital. To adhere strictly to the rule of trading only with a fully developed cause, Wyckoff mandated that traders confirm 3 specific factors before executing any entry. These 3 tests ensure that the trader is acting with the same calculated discipline as the composite operator. They force the trader to look beyond the immediate candlestick and analyze the trade within the context of the larger market structure. This disciplined approach eliminates the impulsive trading that characterizes the inconsistent retail trader. The first test is position. The trader must confirm exactly where the market is within the overall structural framework. Is the cause complete, or are we still languishing in the confusing middle of phase B? A trade is only justified when the structure has moved into phase D. Confirming the successful testing and preparation phases are behind us. Entering in phase A or B violates the rule because the cause is still developing and the outcome remains highly uncertain. The second test is immediate trend. The trader must confirm that the stock is ready to move and is showing clear technical evidence of commitment. This means looking for a decisive sign of strength in an uptrend setup or a clear sign of weakness in a downtrend setup. The entry must be timed precisely with the market's breakout from the trading range, confirmed by high volume that indicates professional participation. Waiting for this immediate trend confirmation prevents the trader from entering too early during a low-volume shakeout. The third test is stock selection. Consistency requires that the chosen stock is moving in harmony with its sector and the general market. A perfectly formed accumulation pattern in an individual stock means little if the overall market index is showing clear signs of broad distribution. The cause must align with the macro environment, confirming that the professional money has a tailwind, not a headwind. Trading against the general market trend significantly increases risk and reduces the probability of a sustained profitable move. Applying the rule of the fully developed cause in an accumulation scenario demands waiting until the market breaks decisively above the resistance of the trading range after the final shakeout in phase C. The phase C shakeout, often a spring, is the last attempt by the composite operator to catch weak stops and ensure all available supply has been absorbed. Once this test is complete, the market is primed for the expansion phase. The subsequent move must be confirmed by specific volume characteristics. The practical method for confirming the sign of strength following the spring involves analyzing the volume signature. A successful spring will typically occur on low volume, indicating that there is little remaining supply left to push the price lower. This low volume test must then be followed by a high volume commitment as the price breaks above the established resistance of the trading range. This high volume commitment, the sign of strength, confirms that the cause is fully developed and the composite operator is actively marking up the price. If the price attempts to break out but does so on low volume, the cause is likely not complete, and the move is a potential temporary upthrust designed to trap eager buyers. Wyckoff's discipline dictates that the trader must wait for the undeniable evidence of professional commitment. Low-volume breakouts often fail and fall back into the trading range, punishing the impatient trader who failed to confirm the structural integrity of the move. Patience is the cost of entry for consistency. The power of the point and figure count is central to applying the cause rule because it transforms market analysis from a subjective art into a quantifiable science. The cause is not merely a visual pattern. It is a measurable amount of time and price movement that translates into a specific price objective for the effect. By counting the horizontal boxes in the accumulation or distribution range, the trader can derive the projected target price. This quantification is essential for disciplined trade management. Consistency is achieved only when the trader calculates the potential effect, the price target, before executing the trade based on the fully developed cause. This calculation must demonstrate a favorable reward-to-risk ratio that justifies the capital commitment. If the point and figure count suggests a minimal move, or if the risk required to enter the trade is disproportionately high compared to the potential reward, the rule dictates a clear action. Do not trade. This adherence to quantifiable risk management, driven by the structural analysis of the cause, is the hallmark of professional trading. The decision not to trade is often the most profitable decision a disciplined Wyckoff trader makes. The rule of the fully developed cause serves as a filter, eliminating low probability, low reward setups that plague the inconsistent trader. The majority of traders enter trades simply because they feel they must be in the market, ignoring the quantifiable evidence that the setup is weak or incomplete. The professional mindset dictates that capital is preserved until the market presents a high probability opportunity where the cause is confirmed and the effect is substantial. The psychological warfare of trading is largely won by adopting this waiting game. The market will always provide temptations, small moves, quick rallies, and dramatic news events to pull the trader away from the structural analysis. These temptations are the primary tools used by the composite operator to ensure that the retail crowd is positioned incorrectly. The consistency Wyckoff taught is the ability to ignore these distractions and maintain focus solely on the completion of the preparatory structure. A common mistake is confusing a minor rally within Phase B with a genuine sign of strength that confirms the cause. A true sign of strength must overcome significant previous resistance on a high, broadening volume, confirming the shift in supply and demand dominance. A minor rally, by contrast, often fizzles out quickly, failing to hold above resistance and indicating that the composite operator is still absorbing shares. The rule requires clear, unambiguous confirmation, not merely hopeful speculation. The discipline required to wait for the fully developed cause is the ultimate test of a trader's commitment to professionalism. It demands acknowledging that the market owes the trader nothing, and that action must be reserved for moments of high certainty. This patience is often misinterpreted as missed opportunities by the retail trader, who fears missing the initial part of the move. However, Wyckoff taught that missing the first 10% of the move is a small price to pay for ensuring the remaining 90% is traded with high confidence and structural backing. Understanding the cause means understanding market intent. When accumulation is complete, the intent is clear: to mark up prices significantly. When distribution is complete, the intent is equally clear: to mark down prices. Trading before this intent is confirmed is speculating on potential. Trading after the cause is confirmed is participating in engineered reality. This distinction fundamentally separates gambling from professional speculation. The structure of the cause also dictates the appropriate stop-loss placement. A trade entered based on a fully developed accumulation structure will have a clear point of invalidation, usually below the spring or the low of the trading range. If the price violates this structural low, it means the cause was not complete, or the composite operator abandoned the campaign. The consistency rule ensures that risk is defined structurally, not arbitrarily, because the entry is tied directly to the completion of the preparatory phase. The failure to use the point and figure count to quantify the cause is a major oversight for those seeking consistency. Without a measurable target, the trader enters the realm of emotional decision-making, unsure of when to take profits or how much risk to assume. Quantification provides the necessary anchor, ensuring that the reward potential justifies the risk taken based on the structural evidence. The cause must be measured, calculated, and confirmed before the trade is executed. Wyckoff's methodology provided a framework for market understanding, but the number one rule, never trade without a fully developed cause, is the behavioral filter. Knowledge is useless without the discipline to apply it only at the optimal moment. The cause is the evidence. The effect is the opportunity. The consistent trader prioritizes the evidence above the opportunity. This approach forces the trader to analyze the market from the outside in, first confirming the larger structural picture before focusing on the precise entry point. The cause provides the macro context, while the sign of strength or weakness provides the micro timing. Both elements must align perfectly to satisfy the rule of the fully developed cause. If the macro structure suggests phase B, no amount of short-term excitement justifies an entry. The constant repetition of analysis during phase B is the preparation required to recognize the completion of the cause in phase C and D. The trader is not passively waiting. They are actively monitoring the supply and demand dynamics, looking for the telltale signs of final absorption or distribution. This active waiting is intellectual engagement, not emotional paralysis. The cause is complete when the professionals have done their work. The rule reinforces the necessity of patience, not just as a virtue, but as a mandatory technical requirement. Premature entries during the development of the cause are often characterized by low volume and weak follow-through, signaling a lack of institutional commitment. The cause is fully developed only when the volume confirms that the smart money is moving decisively in one direction, signaling the end of the preparatory phase. This volume confirmation is non-negotiable. The successful application of Wyckoff's methods demands treating the market as a battlefield where information advantage and patience are the ultimate weapons. The retail trader's disadvantage is their impatience. Their advantage, if they choose to leverage it, is the ability to wait for the composite operator's structural signals. The cause is the blueprint of the professional campaign, and the consistent trader simply waits for the blueprint to be finalized. The rule also protects the trader from overtrading, a common affliction among the 90% who fail. If the cause is not fully developed, the rule dictates remaining in cash, preserving capital for the high probability setups. By restricting entries only to structurally confirmed setups, the trader naturally reduces their frequency of trading, thereby increasing the quality of their decisions and improving overall consistency. Quality over quantity is the direct result of adhering to the cause rule. The ability to identify the completion of the cause requires meticulous charting and annotation. A trader must be able to visually delineate the boundaries of the trading range, identify the initial high-volume events, selling climax, buying climax, and track the subsequent tests of supply or demand. If the chart is messy or the phases are unclear, the cause is likely ambiguous, and the rule demands stepping aside. Ambiguity is the enemy of consistency. Wyckoff's teachings emphasize that the market speaks through price and volume, and the language of the cause is clear only to those who listen carefully. The spring in accumulation is a powerful statement of final absorption. The upthrust after distribution is a final declaration of unloading inventory. These statements must be heard and confirmed before the trade is initiated. The cause is the structural conversation between the composite operator and the market. The temptation to enter early often arises when the market is moving quickly off the lows in an accumulation phase. However, if this move occurs before the final tests of supply, phase C, have been conducted, it is often a false start. The rule requires the trader to resist the fear of missing out and wait for the structural confirmation, knowing that a truly sustained trend will provide multiple safer entry points once the cause is complete. Consistency prioritizes safety over speed. The three tests, position, immediate trend, stock selection, act as a checklist derived directly from the core rule. If even one test fails, the cause is deemed insufficiently developed, and the trade is discarded. This rigorous filtering process ensures that every trade taken is structurally sound and aligns with the intentions of the professional market makers. This is the definition of trading consistency, a repeatable, objective process. The application of the cause rule extends beyond simple entry. It also informs position sizing. A trade entered on a massive, highly developed cause, large point and figure count, justifies a larger position size due to the high probability of a substantial effect. Conversely, a smaller cause, while still valid, suggests a smaller position size. The structural integrity of the cause should directly influence the commitment of capital. The failure of the 90% is fundamentally a failure of patience and structural literacy. They are reactive gamblers, while the consistent trader following Wyckoff's #1 rule is a proactive analyst waiting for the professional confirmation. The market rewards preparation, not prediction, and the cause is the ultimate preparation. Richard Wyckoff's consistency was based on waiting for the market to prove its intent, treating trading as a business of structural preparation, not impulsive prediction. He instilled in his students the necessity of discipline, understanding that the greatest profits are harvested when the market is ready, not when the trader is restless. The cause must be fully realized and quantifiable before a single share is traded. For those dedicated to mastering this structural discipline, Wyckoff's original work remains the foundational text for achieving true market literacy. If you have recognized the profound importance of waiting for the cause to develop fully, and you are seeking the practical, time-tested methods for identifying accumulation and distribution, then I strongly recommend exploring the adapted edition of Richard Wyckoff's classic work, How I Trade and Invest in Stocks and Bonds. This essential resource provides a clear, modern adaptation of Wyckoff's proven techniques for analyzing market intentions, identifying the actions of the large players, and making informed trading decisions based on structural evidence. It is the perfect companion for translating the philosophical necessity of the cause rule into daily, repeatable practice. You can find the link to this foundational text below in the description. The consistency equation is elegantly simple yet profoundly difficult for the majority to execute. Patience plus structural confirmation equals trading consistency. This equation is solved only by adhering strictly to the rule of the fully developed cause. The reward for this discipline is the ability to participate in major market movements with high confidence and minimal emotional interference. The final challenge for every trader is to adopt the perspective of the composite operator. If the cause is not complete, the trader must remain in cash. This is the ultimate test of discipline. It is the single rule that the majority fail, and it is the key that unlocks sustained success in the financial markets.